Hello, welcome to the European Open Briefing for Thursday, March the 22nd. I'm Rafi Barjan, currency analyst at XM.com, and we're going to be taking a look at the latest developments in the currency markets today. So the dollar is the main loser this morning. It fell sharply yesterday after the Fed stuck to its forecasts of 3 rate hikes in 2018. So the dollar sell-off gave other majors a big bump upwards. We saw the euro and the pound both jumping higher. We of course have another central bank meeting today with the Bank of England announcing its decision shortly. The Australian dollar though retreated from its highs following a mixed jobs report out of Australia, while the Reserve Bank of New Zealand also met. They kept rates on hold as expected. But the Kiwi did rise, did extend its gains after that, mainly because the RBNZ removed reference to the exchange rate in its policy statement. So let's take a quick look now at what's happening in both currency and equity markets. We can see the dollar is broadly weaker this morning. The euro is mainly flat. Sterling is slightly firmer. The Aussie, as we said, is retreating after that mixed jobs report. The Kiwi, though, is extending its gains. And if you look at gold, gold is slightly down, although it did rise yesterday after that Fed decision. In equities, Wall Street closed lower yesterday. They weren't too impressed by the Fed's latest projections. In Asia as well, most indices ended the day lower, and in Europe we're having a negative start. The Japanese Nikkei was the exception, closing up 1%, despite the yen rising against the US dollar. So dollar yen has hit a one-week low of 105.55. We can see the dollar index slumping to 1 month low of 89.40. The Federal Reserve yesterday raised its benchmark rate by 25 basis points as expected, and they did keep the number of rate hikes expected in 2018 at 3. Well, that just leaves 2 now. We just had 1 rate hike yesterday, so we've got another 2 rate hikes to go. But in 2019 and 2020, the Fed is expecting to raise rates by one extra. They're expecting 1 extra hikes in both 2019 and 2020. So we do in fact have a steeper rate path for the next 2 years. Growth and inflation forecasts were also broadly revised up, but the not so hawkish projections for 2018 in terms of interest rates are weighing on the US dollar. We do have other risks as well, somewhat weighing on the dollar. We've got the possible government shutdown if Congress fails to approve that 1.3 trillion spending plan. They just unveiled the finalized bill. It needs to be improved by both houses to avoid a shutdown by end of day tomorrow. And we have the ongoing concerns about the trade war. President Trump later today is expected to announce those tariffs on China, mainly targeting the technology sector. And it's rumored that they could amount to $50 billion. Earlier it was reported at 60 billion. We don't know the exact figure yet. If we move now to gold, we can see gold prices jumped higher just as treasury yields fell after the Fed published its latest forecast. Gold rose to a 2-week high, $1,336 an ounce. The 2-year yields had been rising ahead of that Fed decision, hitting a 9.5-year high of 2.366%. They've now eased to around 2.30%. 5 and 10-year yields are also lower in the absence of the Fed signaling a 4th rate hike in 2018. But despite the declining yields, equity markets didn't have a positive impact on equity markets because of that steeper rate path for 2019 and 2020. So although equity markets are concerned by that, Forex markets are focusing on a more shorter term in 2018. Let's now move on to the euro and the pound. We can see the euro managing to recover from those lows we saw on Tuesday following that disappointing zero business sentiment index out of Germany, which showed that trade concerns are starting to impact German business confidence. And we had more disappointing data this morning. The Eurozone flash PMIs fell to 14-month low in March, but investors appear to be shrugging off that for the time being as the euro continues to be lifted by the weaker US dollar. The euro is back above the $1.23 level and rising back above its exponential 21 exponential moving average. And the same applies to sterling. The sterling had actually been given a lift yesterday prior to the dollar sell-off as UK job figures surprised to the upside. We saw the unemployment rate in the UK dropping unexpectedly to 4.3% in January, and average earnings rising to a 2.5-year high of 2.8%. And we just had the retail sales numbers out of the UK. They also surprised to the upside. So all of that increases the likelihood that the Bank of England will signal a rate hike later today when it concludes its 2-day monetary policy meeting. We can see sterling just shy of the 1.5 months high, $1.4177 touched earlier today. If we move on to the Australian and New Zealand dollars, we can see the Aussie recovered back above the 0.77 handle. It did fall back though following the mixed jobs report out of Australia. Although the Australian economy is continuing its record run of creating jobs, in February the headline figure did come in slightly below expectations, and there were more people entering the workforce. The unemployment rate ticked slightly higher. This suggests that there's still a lot of slack in the labour market in Australia. But another factor weighing on the Aussie is the fact that US rates are now above Australia's for the first time since 2000. But the dollar sell-off is having a bigger impact. The Aussie is managing to find support from that for the time being, but could come under pressure from the declining yield differential as we move as the US continues to raise rates in the coming year. If we move on to the New Zealand dollar now, the Kiwi is currently trading around 0.7250. It had actually plunged to 2 months lows yesterday. The RBNZ, they kept rates at 1.75% as was expected. They did remove reference to the exchange rate, so that gave the Kiwi an extra lift. We can see big gains since those lows yesterday and sharply rising above its exponential moving average. It's also worth mentioning that the RBNZ now will have a new governor at its next meeting. Adrian Orr takes over, and the RBNZ will also be having a dual mandate where they're going to be focusing on employment as well as inflation. Could potentially mean lower interest rates over the longer term, but for now, like the Aussie, the Kiwi is benefiting from that dollar sell-off, and the same is true for the Canadian dollar. We can see the loonie jumping to a more than 1 week high of 1.2825 versus the US dollar. That's a big sell-off for dollar loonie. Also lifting the Canadian currency is the renewed optimism about NAFTA. There are reports that the United States is willing to make compromises in the automobile sector, which was a contentious issue. So investors are now much more optimistic about a NAFTA deal being reached. And tomorrow we're going to be seeing Canadian retail sales and inflation numbers that could have a potential impact on rate hike expectations by the Bank of Canada. And finally, looking at today's economic calendar, we can see we had plenty of data this morning. The focus later on will be the Bank of England decision at 12 hours GMT. It's going to be a quieter North American session with just US weekly jobless claims being the major data. That's it from me. Thank you very much for watching and have a great day.